Good morning, everyone. Thank you for joining our Market Pulse webinar. I'm going to give it 2 more minutes before we start because I can see people still joining. I can see people are still joining, but we've got a lot to get through, so I am going to get us started. Hello and welcome to Market Pulse, Credit, Cash, Macroeconomics, UK Consumer Credit Trends into 2027. During this session, we'll be looking at some of the themes from our latest Spending and Lending Consumer Credit Trends report. It's gone live today. We'll be sharing the link with you so that you can download the full report for this quarter's data and insights. I'm Christina Bowood-Ansell, Director of Consumer Product here at Equifax, and I'm pleased to be joined today by Andy Goodwin, Chief UK Economist from Oxford Economics, along with 2 of my colleagues from Equifax, Andrea Cox, Affordability Director, and Reese Howes, Head of Market Intelligence. Before I hand over to our speakers to start, I'm going to run through some very quick housekeeping. Everyone should have joined on mute and off camera, but we do want this to be an interactive discussion. So if you have any questions throughout, please pop them in the chat. We'll do our best to answer them as we go through. For any questions that we don't get round to answering, as long as we can identify you, we will respond directly after the webinar, or there'll be a form at the end where you can submit any questions or observations, and we'll get back to you that way. Our main question is always, can I please get a recording of the call? And luckily for you all, the answer is yes. It will come out to everyone by email on Monday. Housekeeping done. Let's pick up the discussion. So, Andy, I'm going to come to you first. What are the main impacts we've witnessed on the UK economy as a result of the recent Middle East conflict?
Good morning to you all. So, prior to the conflict erupting at the end of February, we had an economy that was sort of stuttering along, pretty steady, unspectacular growth. But I think the onset of conflict has caused quite significant disruption, particularly across sort of factors that affect consumers. Obviously, we had a big spike in oil and gas prices, mainly because one of the main routes for sort of shipping oil and gas products, the Strait of Hormuz, was shut for several months. And we've already seen that have quite a big impact on petrol prices. You sort of think about how much it's sort of cost to fill up the car over the last couple of months compared to what it was like at the start of the year. That sort of impact was pretty instantaneous. And as of last week, 1st of July, we've seen a double-digit increase in the energy price cap. The impact on gas prices is somewhat lagged because of the energy price cap sort of structure. But effectively, that sort of increase is also a consequence of what's happened. Now, what that means is that household spending power is being squeezed progressively. We're sort of in the stage now where I suppose prices are rising at about the same sort of rate that people's wages are, which is a sort of less advantageous position than we'd expected to be in at this stage. We'd expected wages to be growing a little bit faster. And I think that's a particular issue for people towards the bottom of the income distribution, because they tend to spend more on sort of petrol, on sort of energy products as well. So I think, yeah, quite a big squeeze happening there. Now, that's also then likely to affect activity in the economy, so GDP, and that in turn sort of means that people's jobs are probably less secure than they would have been sort of 4 or 5 months ago. So it is something that is having a reasonable impact on the economy, albeit, yeah, I think we are in a very different situation now compared to what we were in 2022 when Russia invaded Ukraine. At that stage, the increases in sort of oil and gas prices were much larger than we've seen now. But I think what that has sort of taught us is that it's sort of taught us the lessons of what happens in that sort of situation, and quite a lot of what we saw play out then is playing out now, but just to a sort of smaller degree. Now, we have had some good news in the last sort of 3 or 4 weeks. We've obviously had a peace deal announced. That has caused oil and gas prices to come back down a bit. So I think that's a good sign. But I think, yeah, it's a fragile ceasefire. You only have to look at the news this morning. Donald Trump has said that as far as he's concerned, the ceasefire is over. I suspect that's probably a slight overreaction on his part, and I don't think this is really an end to the peace deal. But it does reinforce that this is something that still remains pretty tenuous. And even though some of the recent signs have been better, I think it's still going to be quite a challenging year for UK consumers.
Absolutely, thank you. And Andrea, how are lenders incorporating these changes and fluctuations into their lending decisions? Can my panel tech please pull Andrea off mute for me?
Sorry, that was my fault.
Thank you.
Sorry about that. So yeah, as Andy just said, there's been a lot of fluctuations. We had the cost of living crisis that has probably been the longest crisis that we've ever had. So how are lenders looking at this when making lending decisions? The reality is in their affordability checks, and they're having to incorporate these types of fluctuations, but it can be quite difficult. And the reason it can be difficult is that most of the models that are used to verify or validate people's actual spending and cost of living are from models that are at least 12 months old. So, for example, we've just had on the 11th of June the ONS Family Spending Survey updated, but that covers a period from April to March 25, and so doesn't really incorporate the energy price cap changes that we see in the fluctuations in that. So there's no explicit guidance from the FCA on what should a lender do to incorporate these changes, but what they do say is that they should take reasonable and evidence-based assumptions. So in some cases, that can be, just putting buffers in place. So having maybe an extra 5 or 10% to take account of these fluctuations in basically people's energy bills. But in reality, there should be probably some sort of materiality threshold. So if there is a significant change, apply some sort of buffer to affordability calculations then. As I mentioned, the key thing is that most lenders probably use some sort of modelled expenditure. And so what lenders can also do is look at more transactional level data that you can get through something like open banking. And one of the things that we're doing at Equifax is looking at using all the wealth of transactional data that we've got through open banking journeys that our customers have gone on and actually create a unique model that's based on more up-to-date data and that can be more regularly updated. Again, that can be used either as a replacement for ONS or MIS, or it can be used just to validate what customers are declaring themselves as their own what their own energy bills are. So there's lots of ways in which lenders are incorporating these changes, but the key thing is, like I say, just to have reasonable and evidence-based assumptions.
Thank you. And I can see the slides having a look at, we've spoken about the economy, we've spoken about the lenders. I can see us having a look at UK households. So let's move on to how it's impacted household expenditures. Housing costs, whether that's rent, mortgages, council taxes, they are typically the biggest cost for any household. They're actually approximately 20% of the household expenditure. Reece, this might be a surprise as I've asked the other two a question. What changes have we seen in recent years? And I guess, have we started to move away from that mortgage market panic that we've seen? Are we a bit more stable now?
Yes, I think everyone got a bit of a sneak peek there, but there's a few charts and stats that will help to exemplify this. So, unsurprisingly, there's been plenty of ups and downs in the mortgage market over recent years. So if we look at the chart on the top right, this exemplifies that in terms of the mortgage demand. So in 2023, there was a deep contraction in origination volumes due to the interest rate shock and the immediate aftermath of that. And volumes remained relatively sluggish through 2024, despite some modest increase there. As the Bank of England finally began cutting the base rate, we saw consumers start to abandon that wait and see mentality a little bit. And you can see that as a result, we saw a 15% increase in originations in 2025. And these volumes have remained relatively stable since that point as well. So into 2026, we're seeing quite stable behavior there. So those borrowers who've delayed decisions have largely re-entered the market, and then those waiting for significant interest rate cuts have perhaps recalibrated their expectations, especially with the base rate expectations to be quite stable through to 2027 now. What is perhaps more notable here is not necessarily the volume, but the structure of those agreements as well. So we're continually now seeing new mortgage agreements being at loan terms of 35 years or more. So that's continued around 11% consistently now. And that is a threefold increase on the levels we saw prior to the rate increase cycle. So it's a clear example of how consumers are taking those short-term efforts to reduce their costs in order to improve their affordability in the short term, even if that does mean higher costs in the long term. Despite that, costs do remain elevated. So for those new agreements, we see monthly repayments remaining 45% above Jan 2022 levels. So clear impact on that the increased rates there. Despite that, though, we've seen mortgage arrears have reached their lowest levels since early 2023. So things like interest-only conversions, term extensions, payment holidays are clearly providing real relief for any borrowers that are under pressure. That being said, on the next slide, I can explore a little bit how different cohorts would be impacted in different ways. So it shows how housing costs also drive a bit of a generational divide. So if we look at the chart on the right-hand side, this is looking at the total exposure of mortgages. So there's a clear discrepancy there between those younger generations versus baby boomers and silent generation when you look at that white space, which would represent the non-mortgage population. But alongside that, they'll also have lower principal balances remaining. And that's exemplified on the bottom left with that stat. So the repricing cycle really hit millennials hard. And at the end of 2025, the typical monthly mortgage repayment for a millennial was nearly 20% higher than that of a baby boomer. And for context, that gap was just 4.8% back in 2019. So it really shows how the interest rate shock feeds through to different cohorts in different ways. But then the mortgage market is only half that story as well. So we need to look at the consumers in that white space, those who don't have a mortgage, because their realities couldn't be more different again. So the younger demographics, non-mortgage, generally means renting in most cases, and they would have absolutely felt those second round impacts of the interest rate hikes as well, because landlords likely would have passed on the borrowing costs directly into higher rents. Conversely, for the baby boomers and silent generation, non-mortgage there generally means outright ownership. So they own their homes free and clear. They're completely sheltered from those housing cost shocks. So I think it really shows how it's important to consider different cohorts rather than just the aggregate impact here, because it's clear how different cohorts will be impacted very differently by external shocks.
Thanks, Rhys. And talking about shocks, Andy, what do we expect to see for the rest of 2026?
But before we had the peace deal in the middle of June, we were in a situation where financial markets were expecting the Bank of England to increase interest rates. Now that's important because that affects where swap rates are. So effectively the sort of rate at which lenders are borrowing the money to then sort of lend on to consumers. And that was then sort of feeding through into mortgage rates. So mortgage rates were actually quite a lot higher than they were at the start of the year, about 80 to 100 basis points higher. Now, I think what sort of happened in the sort of the course of the last 3 or 4 weeks is that markets have reappraised. So it's largely a sort of function of the peace deal and the expectation that inflation won't be quite as high, and therefore the Bank of England won't need to be to keep policy quite as restrictive as it is. And I think it's also a reflection of what the Bank of England themselves are saying. They're sort of very much saying that this is a situation where they'll wait and see as long as possible. And really, they'll only pull the trigger on actually raising interest rates if they see that what's happening is that we're sort of entering the same sort of vicious cycle that we saw in 2022, where sort of high inflation caused people and firms to expect inflation to remain high, and therefore pay rises, margins sort of went up as well. I think the sort of the chances of that sort of story playing out this time around are actually quite a lot lower. We're in a situation where sort of people just don't have the same wage bargaining power they had back in 2022. Unemployment's higher than it was then. Lot of spare capacity in the labour market and the like. And equally, firms aren't in a particularly strong position either, given that demand is pretty weak, and they're under a lot of pressure from lots of things like national insurance rises, input cost rises themselves. So I think the chances of sort of 2022 being replayed are actually quite low. And what we'll see is that the Bank of England actually keeps its policy rate at the current level of 3.75% for quite a while, probably well into next year. Now, what that should mean is that the swap rates come down as markets sort of reappraise. So what the Bank of England will do, that should also then filter into mortgage rates as well. So I would expect mortgage rates to come down a little bit, so fixed mortgage rates from where they are now. But we're probably still not going to get back to where we started at the sort of start of this year. No, that's pretty important. I think if you sort of think back to sort of the things that Rhys was talking about, obviously the sort of the cost of mortgages sort of now is going to affect originations sort of going forwards, and it also affects that sort of that final cohort who are refinancing the 5-year fixes that were taken out at very sort of cheap rates back in 2021, 2022. So obviously the sort of the further down sort of further back mortgage rates fall in the next couple of months, the better it is in terms of sort of reducing the uplift in those interest rates for those sort of people. So I think it's certainly something that we'll be watching very closely, because that will have quite a big impact on the wider housing market.
Thanks, absolutely. And despite being hit by consecutive financial squeezes, it does seem that consumers are remarkably adaptive. I guess the question is really if we think this resilience is a permanent structural change in the way consumers are behaving. Rhys, what's the data telling us about the consumer spending behaviour?
Yeah, so consumers have adapted in various ways over recent years. I mentioned already the mortgage elongation being one way consumers have adapted, but we've also seen other things such as the e-commerce market, for example. So we continually see each month around 8 to 10% of consumers purchasing from secondhand vendors and marketplaces, also around 5% selling on those platforms to supplement their income. So really showing how that value-driven sustainability model, it's not really a compromise for consumers anymore. It's very much a savvy strategy that they're using to manage their finances. And then alongside that, through the height of the cost of living crisis, we also saw evidence in our data of supermarket switching, so consumers moving to more budget options or cutting back to own brand goods and things like that. That being said, all of these are quite limited options to an extent. There's only so far you can extend your mortgage terms. So we do need to be continually mindful of that consumer capacity and their likely resilience to any future shocks now. But then in regards to how the credit markets are supporting the consumer spending, we're increasingly seeing a more sophisticated, what we're calling consumer toolkit now. So buy now, pay later is firmly an established option in that now for some time. Alongside this, we've seen credit card usage continually increase over recent years. So outstanding debt in the credit card market is now in excess of 80 billion, and new originations have maintained measurement period highs as well. So if we look at March alone, we saw 1.1 million new accounts opened. At the same time, in the revolving retail space, we've seen a bit of adaptation. So providers have started offering more attractive limit offerings, perhaps in a bit of contrast to the lower value buy now, pay later space that is perhaps acting as a bit of a competitive offering in that area. So it's really clear that lenders are adapting to meet demands across the board. I think in future, it isn't really about those categories remaining entirely rigid. The boundaries are naturally blurring across traditional banking and retail lines, introducing flexible installment features and embedded options. So I think consumers are really benefiting from that as well. So it's giving the ability for them to make more tactical choices, picking the exact right mechanism for them for each spending instance.
Great, thank you. And Andy, can you perhaps talk to us, elaborate a bit on why spending is so important for the UK economy?
Sure. I mean, consumer spending is about 60% of the UK economy. So essentially, if the consumer is sort of enduring difficulties, then the wider economy is almost certainly going to be underperforming. And that's very much the case for the UK since the pandemic. We've had an economy that's really sort of just been drifting along at best for the last sort of 5 years or so, generally underperforming its peers. And that underperformance is largely a sort of story of consumer spending sort of not holding up. On an inflation-adjusted basis, consumer spending is only about 1.5% higher now than it was in 2019 before the pandemic, which is for the UK an unprecedented period of weakness. And if you look at the other G7 countries, so that's sort of the biggest economies of the world, there's only Japan that's performed worse than the UK. So I think, that sort of just demonstrates sort of how much we are struggling. And indeed, if you look at the US on the same basis, then spending there is now about 20% higher than it was before the pandemic. So again, that just sort of demonstrates quite how poor the UK's performance has been. I think regular bouts of high inflation are a big sort of part of this. I think it really has eaten into people's spending power over the last sort of few years, and obviously high interest rates have not helped either, particularly for those who are sort of net debtors. So that's been a sort of big challenge. But there has been this sort of general change of behaviour as well, I think, amongst the consumers in aggregate. So there has been much higher levels of saving across the sort of the whole of the sort of consumer sector than there have been, particularly sort of in the lead up to the pandemic, but also sort of going back sort of 20, 30, 40 years. Now, it's quite hard to sort of pin down exactly why that is. I think there are sort of big sort of segment stories there as well, as sort of Reece has alluded to. But really that sort of combination of sort of high inflation, of relatively cautious consumers does mean that it's a big challenge in terms of sort of driving growth going forwards. And a particularly sort of weak part of that is retail spending. We're sort of at the stage now where spending in sort of retail stores is pretty much still at the same level it was back in 2019. So it's very, very challenging for firms in that sector to have a sort of 7-year period of sort of no growth in demand. So really that sort of story, I think, is integral to that wider picture of sort of the UK economy underperforming.
Great, thanks. And of course, you saw it flash up and Reece mentioned it. We can't really talk about consumer spending without mentioning buy now, pay later. I can see a question in the chat as well. So, Andrea, how will the regulation impact both the buy now, pay later providers and other lenders who will have access to the data? And there is also another question in the chat around the effect on the numbers of users of that as well.
Yeah, thanks, Christina. I've seen the question, so I will try and answer that as well as I go through talking about this very important topic. So obviously, buy now, pay later has achieved a genuine mainstream adoption. So today in the UK, 39% of the UK adults use some form of buy now, pay later. Regulatory change comes on the 15th of July, so very soon. It's knocking on our door. So what does that actually mean? So what it means is that all buy now, pay later providers must be FCA authorised. And that what that means is that they have to comply with the FCA prompt handbook. And so buy now, pay later lending data will also be integrated into mainstream credit reporting. So that's a significant development. So for the first time, lenders will be able to see the complete picture of consumers who have buy now, pay later commitments. Okay. So if we look at that and answer your question, do we suspect that the new FCA regulation for buy now, pay later will have an effect on the number of users? That remains to be seen. Okay, but ultimately, what we look at from buy now, pay later providers and what it means to them. So when they're onboarding customers, what they're going to have to do is look a little bit more closely, potentially, at the affordability of that lending. And they're also going to have to do that in a proportional way. So ultimately, what buy now, pay later lenders don't want to do is really introduce any friction at point of sale for a consumer. So it still wants to be a very sort of light touch check on that individual. What will be more apparent is the fact that there's going to have to be more creditworthiness checks. And the purpose of that is to prevent over-indebtedness of consumers. So ultimately, if a consumer looks like they are having financial difficulties, then yes, they may no longer be accepted for a product that they were pre-regulation. But to be honest, buy now, pay later organisations were already doing checks on consumers. It's just that they're quite light checks. And the FCA have been very explicit in the policy statement that the affordability checks or creditworthiness checks that you need to do on a £50 a month transaction or £50 transaction is very different to the affordability approach or creditworthiness approach you would take for a much larger sum, so a car loan or a mortgage or even a higher credit limit. And that proportionality check is really key to ensuring there is very little impact on consumers who can actually afford to take those buy now, pay later options at checkout. One thing that is important is credit stacking. So if we move on to the next slide, there's some information on here. So ultimately, when we've looked at the peak usage month of buy now, pay later for individuals, what we can see is that 46% of customers have 5 or more buy now, pay later products. And over half of those customers with 5 or more products are using more than one buy now, pay later provider. So what that means is with data sharing coming, buy now, pay later data sharing, that will become more visible and ultimately has to be used when making those decisions as to whether or not to lend to an individual at point of sale. Okay, but there are actual positives as well. There's some real positives. So if we move on to the next slide, what we can see is that actually there are a number of what we call credit invisibles. So buy now, pay later is reaching a lot more customers than traditional credit struggled to serve. And that's particularly apparent in the younger cohort as well. So that might mean that people who were previously credit invisible now can be visible through the credit file, which ultimately means they get access to more products as well. So there are positives around buy now, pay later and data sharing. I'm just going to check the questions. So the question is, are there any signs where the borrowers are switching to buy now, pay later from other forms of traditional credit products? And are they increasing their overall credit usage, or did they not use credit previously? So this is an interesting question, and one that Reese and I have actually discussed recently as well. So if you listened earlier to Reese, his comments around how credit card debt has increased, we were talking the other week with Reese about how actually that may be as a result of new products coming into the market through typical credit card providers, therefore giving consumers more choice around how they wish to spend and what types of products. So I think there's definitely been a change already. I think there's more products in the market that allow flexibility, and I think there's more consumer choice. I don't know, Reese, if you've got any more you want to add to that.
Yeah, I think specifically on that credit card point. So we looked again within our transaction data at the total level. We've looked at, if you combine buy now, pay later and credit card repayments on a monthly basis and look at the share and how that's changing over time, we can definitely see a shift, and it suggests that buy now, pay later is taking some of that market share that would have previously gone to credit cards. So, for example, back in at the start of 2023, the proportion of repayments that were going to buy now, pay later of the two products was 15%. But in the most recent data points in early 26, that's now closer to 20 or 25%. So it's clearly that growth in buy now, pay later is clearly coming at the expense of credit cards to some extent. But to your point, consumers will be choosing the right product for their use case at any one time. And I think the content we've got on screen here exemplifies that a bit more as well, Andrea, with regards to that exclusivity as well. So that I think one of the points in the question was around consumers that aren't using other forms of credit. So you can see there that across all buy now, pay later users, around 15% don't hold any other unsecured credit products, and for the youngest demographics, that's closer to 30%. So it's really showing how buy now, pay later is also a really strong entry point for consumers that were maybe underserved previously.
Absolutely, I think that, like you said, that there are a lot of these young cohorts who have a thin credit file. And I think that using buy now, pay later data can actually really help, because it can provide us some additional information. So, for example, if someone has a very thin credit file, but we can see they've had 20 buy now, pay later agreements over several payments, over several years, with no missed payments, it suggests that that individual does have repayment capacity, they do have financial discipline, and they do have an ability to manage short-term credit responsibly. So actually, it can really help us, or can really help lenders in identifying people that they were not able to do before. And so, creates a financial inclusivity rather than excluding them, which we may find they currently are today. And I think from the final point I want to make really is that the challenge for regulators and lenders is to not eliminate access to these products. I think they're really useful. I think that consumers have really bought into them. I use buy now, pay later myself, especially when buying clothes, because it's a good way in which I can buy clothes online and order more than I think that I need, or have a great selection, and then not have that upfront cost to deal with. Because when I return them, obviously, then I'm just paying for the goods that I'm keeping rather than the ones that I ordered. So it can be a lifestyle choice. And I think it's important that we treat it very differently from an affordability point of view than we did high cost short-term loans, because they are very different.
Absolutely. And I also really enjoy using it for exactly the same reason. We have actually had another question on Buy Now, Pay Later, Andrea. The question is the intent with the new legislation to have Buy Now, Pay Later purchases immediately reported at the time of the transaction?
No, that's not. At the moment, the reporting will remain the same as all other credit products. We did see with high cost short-term lending that there was a daily reporting initiative. But like I say, I think given that it's not really the same, there's no immediate need for that. So initially, no. What we will do is we will explore the benefits of actually having more frequent reporting to the credit bureau. But at this moment in time, it remains the same as other credit products. Don't know, Reece, if you've got anything more you want to add to
that? No, I think you covered it, Andrea. All good.
Smashing, thank you. That is all the questions I can see on Buy Now, Pay Later. So let's have a conversation about consumer debt then in this economy. So we can see that total consumer debt figures are slowly rising, but we don't see a big spike in hard arrears that you would predict in a traditional credit model. Reece, what do you think's driving that decoupling?
So there's a few reasons, I think. First of all, we've already mentioned that consumer toolkit. So I think the wealth of options available to consumers now gives them that flexibility to decide which product is right for any individual spending instance. So that definitely will help consumers choose the right product accordingly. Some of those mitigating behaviors that I've mentioned, they of course would have helped, although I've already covered a bit of how these are largely finite options as well. So their future effectiveness might be diminished for any future shocks. One of the areas of maybe not touched on as much in depth is proactive lender engagement and support. And a prime example of that was the mortgage charter. So the interest rate shock hit housing costs directly, and generally that's the highest monthly outgoing for every consumer. So the options that were available as part of the mortgage charter clearly helped to keep any large spike in arrears at bay. So we saw a bit of pressure feed through, but it was quite short-lived in the mortgage market in terms of arrears. So it supported mortgages and mortgage performance specifically, but then I think it likely also helped to reduce any spillover of impact into other credit products as well, because obviously it's such a fundamental core cost to consumers that they would likely prioritize over other products. The fact that they had that relief on that mortgage meant that they didn't then miss payments on other credit products to try and keep up. So I think it's a prime example of how having these temporary respite measures can really effectively support consumers through periods of shock. And then it also ties in as well to consumer duty and the shift in focus to consumer outcomes as well. So, got that an example, but then other examples being lenders continually monitoring their consumers for signs of financial stress, so they can outreach earlier or put appropriate support in place. So that definitely will have helped that shift in mentality to demonstrating consumer outcomes and how products are appropriate for individual consumers. That being said, you'll see in the report that we released today, we have seen some pressure feeding through recently in some markets, particularly unsecured, so within the credit card market and personal loans. We've seen early repayment performance on credit card and unsecured loan vintages from 2025 deteriorating a bit, and that's feeding through into the stock arrears levels as well. So it's not one that we're ringing alarm bells in relation to yet. I think it's something that's emerging, and we'll be continuing monitoring it over time to determine those drivers and whether it's going to be a sustained trend and evidence of wider consumer stress.
Thank you. So thinking about the future forecasts then, and what this holds for us. Andy, the macroeconomic forecasts suggest that the peace talks that you've already spoken about for us and the impacts they have on lower energy caps may just prevent a severe financial crisis. But I guess the question is, does that mean the UK is locked into a period of pretty slow growth and long-term stagnation?
I suppose let's start with the good news. I think we will avoid recession, so I think that is a good thing. That wasn't looking particularly likely 3 or 4 months ago. I think when the sort of Middle East crisis was at its peak. But I think it is important to acknowledge that we're in a worse place today than we were at the start of this year, and it is going to be quite a grind, I think, for the next year or so, while we sort of work our way through the consequences of that sort of bout of higher inflation. I think certainly we're unlikely to have economic growth that's strong enough to keep or to push unemployment down. So I think unemployment is probably going to remain quite close to its current level of sort of 5% plus. It's not just a case of what's happening in terms of sort of the energy crisis, but firms, particularly in the lower paid sectors, are still sort of adjusting to last year's big increases in the living wage and the increase in employers' NICs. So I think the jobs market is still pretty challenging as well. And I think the main thing really surrounding the outlook is just a very high degree of uncertainty. I mentioned earlier that we had sort of some bad news this morning. Donald Trump sort of suggesting that the ceasefire was off. That, as I suspect, will be a temporary thing, and they are still talking in the background. But I think what it does do is it sort of demonstrates quite how fragile things are at the moment, and how things could sort of really sort of spin on a sort of pinhead. If the peace holds, oil prices, gas prices probably come back down further. We should then have a period where I think people's wages will start rising faster than prices, and we will start to feel a little bit better off. So that could be good news. But equally, I think that just sort of the uncertainty is so great that it's as likely that we'll see a situation where oil and gas prices spike up again. And we see a sort of another period where sort of times are a little bit tougher. So I guess that the main sort of message is that that sort of, I suppose, the worst has been avoided so far. We are cautiously optimistic about the future, but I think caution is going to become really be the sort of the message of the day. I think, given the sort of situation in the Middle East at the moment, it would be bold to sort of make very sort of big predictions on one side or the other. So I think people just need to sort of sit back and sort of hope for the best, really.
Makes sense. So we're still going to see every now and then people panic buying the fuel. I'm quite sick of having to go to closed fuel stations. I can't see any more questions in the chat, so let me ask Reece, have you got any final thoughts?
I just wanted to touch on on this topic here, that opportunities to grow point. So we've discussed throughout here around the wealth of options available to consumers, particularly in the unsecured space, and that's from how buy now pay later has become really well established now, how it acts as a real route to credit access for underserved groups. Similarly, we've observed strong origination growth in more embedded retail finance options that really offer flexibility to consumers. And I think what it shows is that there's really strong demand from consumers for credit products, and particularly products that allow them flexibility and support in smoothing their discretionary spending. So I think it all points to the fact that continued innovation across the market and to some of the points Andrea made earlier, sitting that alongside responsible and proportionate regulation, it can really lead to an effective ecosystem and one that consumers can really benefit from as well.
Thank you. I'm just doing a final check that I can't see any more questions. I can't believe we've managed to answer them all. I think that is a first. So thank you, Reece, and thank you, Andy and Andrea. That does bring us very comfortably within the time that we had for this webinar. Thank you for everybody that did join. I hope you found it useful. If you do have any other questions, if you think about questions as you go on, we do have a short form, and there is a link in the chat to that form. The QR code that you can see on the screen now, you've heard us mention a few times now, the spending and lending report that went live today, that will take you to that report. It's got a lot of the stats and the details that have been discussed in today's meeting, but also it's got a future forward-looking piece by Andy in there as well. This report that we do release from Equifax is a quarterly report. So without wishing summer away, do look out for it in the autumn as well. A final reminder that the recording will come out to you all. It will come out by email on Monday. So if you want to rewatch it, you'll also be able to share it if you want to share it with colleagues. With that, have a wonderful rest of your day, and thank you again for joining.